The 4% rule is dead. Here's what to do instead. If you are planning your retirement, you have probably heard of the 4% rule. It sounds simple. Withdraw 4% of your portfolio each year, adjust for inflation, and your money should last. For years, people have treated this like a safe formula. I am going to show you why that thinking can get you into trouble. The 4% rule was built on historical data. It looked at past market performance and asked what withdrawal rate would survive a 30-year retirement. 4% worked under those conditions. But here is the issue. Those conditions are not the same today. People are living longer. Many retirements now last 35 to 40 years. Markets are more volatile. Inflation has proven it can spike fast. And bond yields have not always provided the stability retirees expect. That changes the entire equation. The biggest risk you face is not average returns. It is something called sequence of returns risk. This is where the order of market returns matters more than the average. Let me give you a quick example. You retire with $1 million. You plan to withdraw $40,000 per year. If the market drops 20% in your first year, your portfolio falls to $800,000. You still need your $40,000. Now you are down to $760,000. You just locked in losses. Now your portfolio has to work much harder to recover, and you are still withdrawing from it. That is how retirement plans break. The 4% rule does not protect you from this. It assumes you keep withdrawing the same amount no matter what happens. In real life, that is risky. So what should you do instead? First, you need flexibility. Instead of taking the same amount every year, adjust your withdrawals based on market conditions. In strong years, you can spend more. In weak years, you cut back. Even small adjustments can make a big difference over time. Second, build multiple income streams. Do not rely only on your portfolio. Social Security helps. Dividends can help. Even part-time income can reduce pressure on your investments. Third, keep a cash buffer. Hold 2 to 3 years of expenses in cash or low-risk accounts. When the market drops, you spend from that instead of selling investments at a loss. This gives your portfolio time to recover. Finally, use guardrails. Set limits for your withdrawals. If your portfolio grows, you can increase spending. If it drops, you tighten up. This creates a system that adapts instead of breaking. Here is the bottom line. The 4% rule is not a guarantee. It is a guideline built on the past. Your retirement is happening in a different environment. You need a strategy that can adjust when things change. Now I want to hear from you. Do you still trust the 4% rule, or do you think it is outdated? Drop your thoughts in the comments.